Good afternoon, everyone. Welcome to Nova 401k Associates on Introduction to 401k Plans for Plan Sponsors. Today's webinar is eligible for Texas CPA credit. Right after the webinar ends, you will see the survey pop up if you are needing CPA credit. We have also added the slides as a handout. Just click the handout dropdown on your GoToWebinar panel, and you can download and save the file to your local folder. Today's presentation will be presented by Team Leader Jason Worms and Account Manager Becky Ray. If you have any questions, please type them in the questions box and enter in the slide number your question pertains to if applicable. And we will go over these questions at the end of the presentation. Becky, we're ready when you are.
Thank you. First of all, we're going to just mention our disclaimer. The information in this presentation is general in nature and not intended to be a substitute for legal or tax advice. Please consult a qualified professional such as an attorney or accountant if you need legal or tax advice. For those who need CPA credit, Nova's provider number is 009820. You will need to register individually and be present for the entire seminar. At the end of the seminar, you will receive an evaluation form to complete, and you will receive your certification within 1 week. Okay, let's go over the agenda. Today we're going to talk about 401k plans, specifically the roles and responsibilities of the different entities involved with your retirement plan. We'll go over Nova's cybersecurity measures, the 401k basics, the moving pieces of a 401k plan, information on the plan distributions and plan loans, and an annual calendar summary to just give you an idea of what the life of a 401k plan is throughout the year. Right, so here we're going to talk about the different entities involved with your 401k plan. First of all, you have the plan sponsor. The plan sponsor has the overall fiduciary responsibility for the 401k plan. The plan sponsor will communicate the plan to participants. The plan sponsor will remit plan contributions to the custodian and provide data to the TPA annually. The data is what the TPA or Nova will use on an annual basis to do the required compliance testing. Next, you have the financial advisor. The financial advisor will assist with vendor selections and fund monitoring. They will coordinate enrollment meetings for plan participants, provide investment education, and assist the plan sponsor with a 404C compliance. And next you will have the TPA. The TPA will prepare and maintain the plan document. The plan document is the legal instrument that governs the operation of the 401k plan. The TPA will complete the required annual testing, prepare the annual filings. The annual filing is the 5,500 and provide ongoing plan consulting. And last, you will have your investment provider. The investment provider is the custodian of the plan assets. The investment provider will invest plan contributions and provide daily record keeping. They will provide participant statements and be responsible for the plan distributions, including tax withholding and 1099 reporting. Next, we're going to talk about Nova's cybersecurity measures. There's a lot of money in 401k plans, and the bad guys have taken notice. We want to make sure that the data that we have for your plan is secure, and that we do everything to educate ourselves about the coordinated attacks on record keepers. Oftentimes, these attacks may start as phishing attacks or hacks on employees' emails, and the bad guys are looking for information such as social security numbers, passwords, birth dates. Attackers then can take that information to contact the record keepers and reset passwords. And then with those new passwords, they have access to the account and can request loans and distributions. Loans and distributions are the way the money leaves the plan. And with technology, especially with ACHs and wires, a lot of money can leave the plan if secure measures aren't in place. And typically, only small amounts are recovered when the theft is discovered. This type of theft is not covered by a fidelity bond, fiduciary insurance, or E&O insurance. So we have to make sure that we have the security measures in place to avoid this type of theft. We have to be alert and do our part to prevent the fraudsters from stealing plan assets. So the type of information that flows between the different entities involved in your retirement plan in NOVA would be census files, deferral files, payroll files, and address files. Now, all of these types of files usually will have social security numbers of employees and birth dates, and you know, the type of information that somebody trying to do harm will use to gain access to the employee's account at the record keeper. In addition, there will be reports provided to plan sponsors that have different types of non-discrimination tests. Most software these days will mask social security numbers, but some do not. You'll have annual valuation reports, which once again will have some personal information, hopefully mass social security numbers. They could have birth dates. And then we often receive tax forms from plan sponsors. So those would be W-2s, K-1s, and Schedule Cs. In these cases, all of these forms have social security numbers in them. Because of this type of information, we want to make sure that these types of files are never sent via email without encryption. It's important to note that a password protected file is not an encrypted file. NOVA has a secure web portal within our plan sponsor link to make sure that information is transmitted and received in a secure manner. We have a secure file exchange where you can send us files with confidential information in an encrypted manner. What happens is you log into our portal, you will select secure file exchange, you can attach the file, and then the person at NOVA, usually your account manager, will receive notification that you've uploaded a file, and then that person can download the file in a secure manner. Another thing that we do is make sure that we have authorization before we will add new plan contacts to our system. So if there's a request for a new plan contact to be added, we will reach out to an existing contact before adding the new contact to our system, just to make sure that we have that authorization. We have mandatory training for all NOVA associates every quarter. This training will provide NOVA associates with the most recent types of cyber crime, how to recognize cybercrime, just really making sure that we're up to date on what the bad guys are doing, so that we can recognize if something might be going on. We change our passwords every 90 days with all of our vendors, all the record keepers we use, and our systems internally. So we do all of this to make sure that we minimize the chances of the bad guys doing anything. And as I mentioned before, you can provide the census information on an annual basis through an encrypted method that will be uploaded to our portal. You can use our secure file exchange. And another thing that's good is just to limit the number of people copied on emails. Oftentimes the bad guys will hack into email. So the more people who are on an email, the more opportunities there are for hacking. Another thing is to use complex passwords and change them often. I know it can be a hassle to have a lot of different passwords, but it really is important, and it's the first line of defense as far as keeping your accounts secure. All right, let's start with 401k basics. 401k plans are probably the most common type of qualified retirement plan right now. It gives employees an opportunity to save for retirement on a tax-preferred basis. With the exception of Roth contributions, the money going into a 401k plan is on a pre-tax basis. Payroll deduction is the best way to save. Once employees have set up their employee deferral through payroll deduction, they don't have to think about the money going into the plan. It's an automatic. And for many people, their 401k account is their biggest asset outside of their home. So, so this is the best way to save for retirement. And it's also a valuable employee benefit. Not only can an employee save for retirement with a 401k plan by contributing money from their wages, but and plan sponsors can also contribute on behalf of employees via employer contributions, such as a match or a profit sharing contribution. One thing that I want to point out is that 401k plans are heavily regulated, both by the IRS and the DOL. The IRS and the DOL are focused on different things, and common sense does not always prevail. The rules frequently change, so we really have to be on our toes as far as keeping track of these rules and how they affect your plan. In most cases, your written plan document is going to include all of the rules. And so NOVA keeps up on those rules and makes sure that your plan document incorporates all of those. Now, as I mentioned, the IRS and the DOL are focused on different things. The IRS is going to be concerned with the compliance with the federal statute and IRS regulations. And they're going to be focused on non-discrimination testing. We'll talk about non-discrimination testing later, but basically it's looking at whether or not a plan is fair, is operating in a fair manner when looking at owners and highly paid employees versus the rank and file. The IRS is also going to be concerned with taxable events. There is a deduction limit, so there's only so much that an employer can put in a retirement plan each year and take a deduction for it. inadequate. And so the IRS is going to be concerned about that. They want to know that a plan document is timely amended. So the plan document has to reflect the operation of the plan. So if you decide that you want to change any of the provisions of the plan, such as when an employee could participate in the plan, you need to make sure that the plan document reflects that change. And the IRS wants to know that once the plan document is executed, that the terms of the plan are followed. Now, the DOL is going to be focused on whether or not 401k deferrals and loans are deposited in a timely manner. Once those dollars are deducted from employee or participant wages, they become plan assets. So the DOL wants to make sure that money isn't sitting in the plan sponsor bank account, but rather is transmitted to the custodian and invested on behalf of plan participants. The DOL is going to be concerned about the fund lineup offered to participants, and that it's prudent. They're going to make sure, oftentimes with younger participants, the fund lineup would be more aggressive than older participants. So they're going to look to make sure that the funds are prudent. They want to make sure that expenses paid by the plan are reasonable, and that the Form 5500 is submitted on an annual basis. So let's go over one example. In this case, the plan sponsor wants to exclude hourly employees from his 401k plan. Now, first of all, the plan document must be written to exclude hourly employees. So that's the first condition, because you have to operate your plan in compliance with the plan document. But another thing that you need to consider is whether or not your plan could pass the IRS coverage test. So the IRS coverage test basically looks at your employee population, and it's a numerical test that checks to see if enough employees are covered by the plan. So the plan can't just be in existence for the owners. It has to cover a sufficient amount of rank and file employees in order to pass this coverage test. So when we look to exclude our employees for a plan sponsor, when we're looking to make that change in your plan document, we will also look to see if we do make that change, can your plan pass the coverage test? And if it can't, then we'll consult with the plan sponsor to see what other options there are. But that's just something to keep in mind. Okay, so our next example is a situation where what is the preferred investment alternative for an employee who puts money into a 401k plan but fails to make an investment election. So in this case, the employee completed a deferral election form. It was saying, I elect to defer, let's say 10% of my salary on a pre-tax basis to go into the 401k plan. And there would also be a section of the election form where the employee is going to choose how that money is invested. But oftentimes an employee might not fill out that investment selection. So what happens in that case is the plan will have a default investment alternative. That basically, that's where the money will go until the employee makes a different fund election. Up until recently, money market funds and stable value funds were the most commonly used default investments. But recently, the DOL has said that balanced funds or life cycle funds are really better default investments. And I think this is primarily because money market and stable funds are conservative investments, and the default investment should consider what type of investment is appropriate for a younger participant versus an older participant. The DOL is very focused on the timely deposits of 401k contributions and loan repayments. So in 2010, the DOL provided a safe harbor time frame for small plans. Now, a small plan would be considered a plan with less than 100 participants. And in this regulation issued in 2010, the DOL said that deposits of 401k contributions and loan repayments would be considered timely if they are deposited within 7 business days after the date they are withheld. For large plans, it's a little different. The timing of the deposit is considered timely if the deposit is made the earlier of as soon as administratively possible and no later than the 15th business day of the month following the date the dollars were withheld from pay. Now, the key here is that the administratively possible is really what's important to recognize. Usually, it's going to be on the pay date or within a couple days. So upon DOL audit, a plan sponsor, if the deposits are occurring more than a day or two after that pay date, the plan sponsor is going to have to show to the Department of Labor why they couldn't deposit the funds earlier. So that's really important to keep in mind. It's a huge issue in DOL audits. For large plans that are subject to an annual audit, it's something that the auditors will also look at. And if deposits are late, that has to be reported on the annual filing as well. Now, the annual filing for a 401k plan is the Form 5500. This is an informational return. It is required to be electronically filed. The information in the return is basically participant counts, fees paid from the plan, the plan's income statement. So the plan's income statement would be breakdown of contributions sent to the custodian, trust earnings, distributions from the plan, as I mentioned, fees paid from the plan, and the amount of the fidelity bond that covers the plan. So just basic information like that. One thing to note is this is an informational return, and when it's filed, it's immediately accessible on the Department of Labor's website. So the information included in the 5500 is not confidential. Now, as I mentioned, the 5500 must report the amount of the plan's fidelity bond. So a fidelity bond covers the plan assets, and it protects the plan assets from misuse or misappropriation by plan fiduciaries. And it has to be at least 10% of plan assets with $1,000 minimum, and can max out at about 500,000, but there are some, it might need to be higher depending on the type of investments in the plan. And there are also certain plans that must attach a copy of an audit report prepared by an independent CPA. So those are plans with more than 100 participants. Now, the plan audit will the auditors will look at deposit of contributions and the timing of those. They'll look at the financial information from the custodian. And so that sort of thing. They'll test deferral elections and how they were calculated. So they'll test a population of the plan sponsor's employees, and then they'll issue a report at the end of the audit that will need to be attached to the 5500. Next, we're going to talk about payroll integration and what it is. A payroll integration is where a payroll provider will talk to the record keeper of the plan. So in the case of integration, the plan sponsor provides payroll information to the payroll provider, and then instead of the plan sponsor having to also provide that same information to the record keeper, the payroll provider will submit the full census data each pay period. So the census data is going to include addresses, birth dates, hire dates, termination dates, compensation for that pay period, deferral amounts, etc. And this will include all employees, regardless of whether or not they are participating in the plan. So the benefit of using payroll integration is that throughout the year, the payroll provider is going to be providing complete census data to the record keeper, and the record keeper will be accumulating that throughout the year. They will have the information then to process automatic distributions because they will know that a participant has terminated and is eligible to take a distribution. The record keeper could send a distribution packet to a participant after they terminate. And if your plan allows for it, then anybody who is terminated with an account balance of less than $5,000 can be forced out of the plan, and the record keeper can initiate that. The record keeper can track enrollment. So with that full census data being provided by the payroll provider every pay period, then the record keeper will know who is eligible to participate, and they can proactively send out an enrollment packet to a participant once they're eligible, as opposed to the plan sponsor's HR department or benefits department having to do that. And because the census data at the record keeper is updated on a payroll basis, then all address changes and relevant employment dates are updated. So if a mailing needs to go out to a participant, we're going to know that the address is the most recent. Now, there are two types of payroll integration. The first is payroll 360, and that's where the census data is flowing in two ways. So it's going to go from the payroll provider to the record keeper, and then payroll changes will be provided to the payroll vendor from the record keeper. So in this case, employees can log into the record keeper site. They can change their deferral percentages. And so the record keeper is going to communicate that directly to the payroll vendor, and the payroll vendor will update their records. Then then the next payroll, they will calculate the deferral amounts based on those changes and then transmit the contributions back to the payroll or back to the record keeper. In the case of a payroll 180, the information only flows one way, and that is from the payroll vendor to the record keeper. So in the payroll 180 situation, if a participant logs into the record keeper and changes their deferral election, then that will be communicated to the plan sponsor. The plan sponsor will then need to communicate that change to the payroll vendor. Now, I touched on non-discrimination testing in a previous slide. Non-discrimination testing is basically looking to make sure that the rank and file employees are sufficiently covered and receive sufficient contributions when compared to highly compensated employees who are basically the owners, family members of owners, and certain employees that receive compensation above a certain threshold. For 401k plans, the basic or the main non-discrimination test is called the ADP test. And this will compare the amount of the 401k deferrals that highly compensated employees make to the plan, and compare that to the deferrals of the non-highly compensated employees. And if there is too much of a difference between those group deferral rates, then a correction has to occur. Usually this failure is corrected by issuing taxable refunds to highly compensated employees. So these refunds will occur after the end of the plan year and will be taxable to those highly compensated employees in the year of the refund. Now, who is a highly compensated employee for 2021? That would be any employee in the testing year who earned more than $130,000 in the prior year. So in the case of 2021, it would be anyone who earned more than $130,000 in 2020. Or it would be anyone who is greater than a 5% owner. And it's important to point out here that a 5% owner for our purposes is actually somebody who owns more than 5%. So if they own just 5%, they would not be considered a highly compensated employee for this purpose. So if they had owned 5.01%, then they would. Any lineal family members or spouses of direct 5% owners working at the company would also be considered highly compensated. So that 5% owner's ownership would be attributed to family members. Another test that is important to focus on is called the top-heavy test. And this test is looks to see if the balance for key employees, which is a similar test to highly compensated, but slightly different. It mostly looks at owners and officers. So if the balance for key employees are more than 60% of the total balances of the plan is considered top-heavy. So in that case, a top-heavy plan would be required to make certain contributions for non-key employees. So every year during the compliance testing process, NOVA will look to see if the plan is top-heavy and will make sure that the minimum top-heavy contributions are made for the non-key employees. All right, so who is a key employee? So that would be any employee who is a greater than 5% owner or a 1% owner with compensation greater than $150,000, or an officer with compensation greater than $185,000, or a lineal family member or spouse of a direct 5% owner working at the company. So as you can see, it's similar to the highly compensated definition, but slightly different. All right, so there are two different types of 401k plans. There is a basic 401k plan, and then what is a safe harbor plan. And a safe harbor plan guarantees some employer contributions to the participants. And what that does is it eliminates the need to run the ADP and ACP tests and the top-heavy test. So as I mentioned before with the ADP test, that's where if it doesn't pass, highly compensated employees would need to take money out of the plan that is taxable. So by having safe harbor provisions in your plan, you can eliminate the need to do that, as well as make top-heavy minimum contributions. So there are two types of safe harbor plans. The first is a safe harbor matching plan. So that is where a basic matching formula equal to 100% of the first 3% deferred plus 50% on the next 2% is contributed to plan participants. So a match is an employer contribution that will only be contributed to participants who make 401k deferrals into the plan. So by contributing this safe harbor match, the ADP test can be avoided. And if the employer match is the only employer contribution, then the top-heavy minimum contribution requirement is waived if your plan is top-heavy. Now, the other type of safe harbor plan has a safe harbor non-elective contribution. So in this case, it would be equal to 3% of pay, regardless of whether or not the employee contributes. So in both cases, the safe harbor contributions, whether match or non-elective, would be fully vested. So on an annual basis, NOVA is going to do the non-discrimination testing. We've covered or touched on the coverage testing. So that is looking to make sure that enough rank and file employees are covered by the plan. Also, we'll do profit sharing testing. So based on the provisions of the plan, we may be able to skew profit sharing contributions to certain people, usually highly compensated employees. And so this test will look to make sure that there's not too much of a disparity between the profit sharing rates to highly compensated employees when compared to the rates allocated to non-highly compensated employees. In addition, we will do compensation testing in cases where the plan document excludes certain types of compensation when allocating employer contributions. So an example would be where a plan document says that commissions are excluded for purposes of calculating the profit sharing contribution. So in the example, you might have a plan sponsor where all of the people who receive commissions are non-highly compensated employees. And so what we'll do when running this test is make sure that a high enough percentage of compensation for non-highly compensated employees is used to calculate the profit sharing contribution when compared to the highly compensated employees. So each year we are going to look at your plan, what's occurred within your plan, and make sure that all of the necessary non-discrimination testing is run. If it fails, we will contact you and consult with you, talk about the test and how it needs to be corrected. And if necessary, maybe suggest some plan design changes going forward that can help minimize test failures. As I mentioned before, plan documents are the legal instrument that governs the operation of the retirement plan. They have to be amended from time to time to stay current with new legislation or IRS regulation. So typically every 6 to 8 years, plan documents have to be restated. Right now we're actually in the process of a restatement period. Those the restatements are necessary to make sure that all of the new laws and regulations during the 6-year period are incorporated into the retirement plan. These restatements and amendments need to be executed timely, and there are penalties for failure to execute timely amendments. Now, the plan document is going to have a lot of information in it. You will mostly refer to the adoption agreement, which is basically a checklist of the plan with an underlying basic document that really has all the meat of the legalese of the plan. So basically, in the adoption agreement, you will refer to that for the eligibility terms of the plan. So eligibility is going to tell us who can participate in the plan and when they can participate in the plan. So if there might be a wait, like a 1-year wait before an employee can participate in the plan, so the adoption agreement will define that. Also, once that wait is satisfied, when the employee can start participating, we call that an entry date. The plan document is going to define compensation. So what is the starting point of compensation? Is it W-2 compensation? And is there any compensation excluded? The document will tell us what employer contributions are allowed in the plan. As I mentioned before, there could be employer matching contributions or employer profit sharing or what we call non-elective contributions. So the plan document is going to tell us that. The plan document will tell us whether or not Roth deferrals are allowed. These are 401k deferrals that are after tax. And finally, the adoption agreement is going to tell us what the vesting in the plan is. So oftentimes, employer contributions are subject to a vesting schedule. So the purpose of the vesting is to increase the participants' ownership in employer contributions based on the years of service an employee has with the employer. Now, let's go over some common plan sponsor payroll errors. One very common error is to exclude bonuses from deferral elections. So unless your plan document specifically excludes bonus compensation for purposes of employee deferrals, the deferrals need to be withheld from bonuses. Excluding part-time employees from a plan. So it's fine to exclude part-time employees, but it has to be written into your plan document. Matching catch-up contributions separately from non-catch-up. So catch-up contributions, it's a higher 401k deferral limit for people who are at least 50 years old. They basically, for purposes of matching contributions, they're regular 401k deferrals. And they should be combined with the regular deferrals when calculating the match. Also, if a plan offers Roth contributions, then it's important when calculating the employer match to combine the Roth and pre-tax contributions when calculating the match. There are not two separate matching contributions, one for Roth and one for pre-tax. Another common error is not distributing the summary plan description to employees. So the summary plan description is basically, it provides in an easily understandable format the provisions of the plan for employees so that they have the information that they need to make decisions about their enrollment. Another common error is not allowing new employees to participate pursuant to the plan. So once an employee meets the eligibility conditions and enters the plan on the entry date, they are eligible to participate and need to be given the opportunity to participate in the plan. Now, for non-discrimination purposes, most match formulas are designed with a cap, basically that only the deferrals up to a certain level of compensation are matched. So it's a common error to not limit the matching contributions to the cap, compensation cap. Okay, so let's look at an example where there were participants who were not allowed to enroll on time. So ABC Company's plan has no age or service requirement, but does offer Steve enrollment into their 401k plan for 6 months. Does not offer Steve enrollment into their 401k plan for 6 months. In this case, the ABC, it's what we call a missed deferral opportunity. So ABC Company will have to make Steve whole by making an employer contribution for the missed deferrals, as well as the related employer match and lost earnings on those contributions into the plan. So it's very important to stay on top of the enrollment dates for new employees and make sure that they're given the opportunity to participate as soon as they are eligible. In this example, we're going to look at not properly capping the matching contribution. So for this plan, the matching formula for 2021 is 50% of deferrals on the first 6% of compensation. So for a case where you have an employee who has compensation limited to $290,000, which is the maximum amount for 2021 that can be considered plan compensation, the 3% of the $290,000 would equal $8,700. So in this case, an employee maybe made more than $290,000. So it's important to remember what that compensation limit is and apply it. If the cap isn't applied, then that excess amount would need to be forfeited, which means removing it from the participant's account. Okay, let's look at initial eligibility. In this case, the maximum waiting period is 1 year and age 21 with a minimum of 2 entry dates. With 1 year of service, a certain number of hours may be required in order to accrue that year of service, but cannot be more than 1,000 hours. The age requirement cannot exceed age 21. It can be lower than 21, but it cannot be greater than 21. And it's okay to have shorter waiting periods. The initial computation period is the 12-month anniversary from the date of hire, then typically changes to the plan year. So in this example here, we have a date of hire of June 1st, 2019. And so the anniversary date is going to be June 1st, 2020. So within that measurement period, we will look to see if 1,000 hours were credited to the employee. Now, this is a measurement period. So the employee can't enter the plan until after that measurement period. But the employee may not be employed that entire measurement period. So that's one important thing to note. Also, the measurement period is basically a wait. So even if an employee was credited with at least 1,000 hours prior to June 1st, 2020, we still have to wait the entire 12 months to the anniversary date. And then if the 1,000-hour requirement is met, the employee would enter on the next entry date. So in this example, the entry dates are January 1 and July 1st. The year of service is met on June 1st, 2020. So the employee enters the plan on July 1st, 2020. Next, we're going to talk about dealing with rehires. If a formerly eligible employee had ever had a single vested dollar in the plan, he or she will never lose their prior service credit. So when they are rehired, they immediately enter the plan because that prior service counts. Otherwise, they lose their prior service credits after 5 consecutive one-year breaks in service. So when you have a rehire, if 5 years have not passed, or if the employee was previously a participant with a vested balance in the account, then that person is going to re-enter the plan immediately. So in case of the 5-year consecutive one-year breaks in service, if that applies, then they would be treated as a new hire. But the majority of the time, rehired employees will enter the plan immediately if they had participated previously or had previously met the eligibility requirements, but just had not entered the plan. Okay, I am going to hand the rest of the presentation off to Jason.
Okay, thank you very much, and I appreciate you going through that first portion of it, Becky. I'm getting my screen share set up, folks, so bear with me for just a moment. Sorry about that, just had to get a clean version so you guys don't see anything that would distract you from the show. So, getting down here to the right spot. Okay, so I'm going to be talking first off about a kind of a return to talking about the roles and responsibilities that Becky touched on earlier, because we're going to be talking about how distributions and loans get processed, and we're also going to be talking about the annual compliance calendar for the plan. And it's important to kind of refresh in our brains who is responsible for what within the plan in order to have a good idea of what we're getting into for the roles and responsibilities with those items. So, you know, like Becky talked about before, and I'm not going to spend a ton of time on this just to keep us on track time-wise, but the record keeper, the investment provider, that's your John Hancocks, the Empowers, the Voyas, the Transamericas of the world that hold on to the funds. They're the ones that send out the statements to the participants. A lot of times they'll do enrollment and education meetings for the participants, and they'll be the ones that actually send out distribution and loan checks to your participants. They're also the one that you're going to be sending payroll files to and things like that. The TPA is what Nova does. We do the compliance testing for your plan. So, you know, when Becky was talking earlier about safe harbor versus not and some of the plan provisions and things like that, that is the expertise that a TPA brings to the table for working on your plan. So we help you with your plan design and figuring out what works best for you. We deal with government reporting, preparing that form 5500, and then we also provide distribution and loan expertise. So we confirm in a lot of cases if your plan allows a particular type of distribution or loan that your participants are requesting, or we will also verify things like the vesting percentage is accurate before distribution gets paid out. Many plans and most Nova clients have an investment advisor in the relationship as well. This financial professional, a lot of times, is the one who is your existing relationship. Okay, either they've been the financial advisor for your company for things like, I don't know, maybe insurance or other things, and they offer this 401k consulting as an additional service. But but they are typically the person that brings the business to Nova and to the record keeper. They also will do typically annual reviews with you and your management group about the plan. And they will also help out with enrollment meetings and get your participants signed up for the plan and help them choose the investments that make the most sense for them. So we talked a little bit that the record keeper holds the money, but how does the money get there, right? So nearly all of the record keepers have a secure website where you can upload contribution files. So if you get an Excel file or a CSV or even a text file from your payroll provider, your record keeper is going to have a secure website where you can upload that information that breaks down the deposit by the contribution type and by the participant, so it can be funded. Some record keepers, and more each day, are investing in the technology that might interact directly with your payroll provider. And so that's what Becky was touching on with the 180 and the 300 and the 360 services that she mentioned before. So that would be kind of taking you out of the middle of that process, and your payroll provider and the record keeper communicate directly to get that deposit handled. The record keeper, once they have those funds, they are responsible for keeping track of those funds broken down by the money type, by the participant, and by the investment. So they do all of, that's what they're called, the record keepers. They keep track of all the records of where each penny in your plan, where it belongs. And they do all of the work and the trading to keep all that organized. Okay. Becky talked a little bit about match contributions. So who calculates those? It really depends. There's a couple of different options. The first one is if you make your match contribution on a per pay period basis, it's generally calculated by your payroll company, right? So at some point, you had to communicate with them about what your match formula is so that they could enter it into their system, and then they kind of do the rest. At the end of the year, Nova will do a review of the match contributions that were actually made to your employees to confirm that nobody received more money than they should have. But for the most part, your payroll company is going to be the one who's handling that. If you do your payroll in-house, or if you and you don't really know how to set up your match formula or something along those lines, I definitely encourage you to contact your account manager at Nova, and they can help you get that formula set up. So the other way of doing a match is what's called an annual match. So no match contributions are made throughout the year, but at the end of the year, when you send your compliance data into Nova to do our non-discrimination testing on your behalf, we can also calculate your match contribution as part of those services. That comes at no additional cost. Nova can do that for free, along with our annual compliance services. It would just be a matter of you telling us what the match formula is that you want to allocate, or if you have a specific budget amount, give us that budget and we can allocate it in a IRS acceptable way among the participants with deferrals. Okay, moving on from match contributions to the Form 5500. In 99% of cases, Nova is going to prepare the 5500. Okay, we do that for, like I said, just about all of our clients. Now, while we prepare the form, only the plan sponsor, the plan administrator, is authorized to sign the form and actually send it into the Department of Labor. So, so Nova will prepare the form. We will send it to you as the plan sponsor for signature, and we can even give you instructions on how to apply your electronic signature credentials to the form and send it to the Department of Labor. But we can't actually do that step of signing for you. So that's how the Form 5500 works. It's a relatively low intensity process for the plan sponsors, but we do need your help to get that form over the finish line each year. Okay, and probably the thing that out of these that you're probably going to deal with the most is distribution paperwork, right? You have turnover in your firm. Maybe last year you had more than normal, but what you want to do is you want to make sure that your participants that are no longer working with you have a chance to access their funds and take that distribution of their account. So a couple of best practices for that is ideally you're able to give your participants a distribution form as part of their exit interview. when you give them their COBRA notices and other items as part of their exit or their last day, you can give them the distribution form as well. More and more participants are using the online services offered by the record keepers, and a lot of record keepers now are also offering online distribution and loan requests. So, and a lot of them will provide like one-page flyers or little letters or something that you can also give to those employees on their way out the door so they can easily access their account. Nova can also help you by sending distribution forms to participants or sending you copies of forms if you need them. So don't hesitate to contact us. We can also mail the forms directly to your participants if you choose. These days, email has become a much more frequent method of sending those forms out. And in many cases, the forms don't include any personally identifiable information on them at the beginning, so they're perfectly acceptable to send via email. Okay, this one is probably one of the least well understood, or the one that we typically go over multiple times with our clients, with our advisors, even internally, is talking about notices. So all retirement plans have several notices that they have to send out to their participants on a regular basis. Okay, so things like a summary plan description, things like a summary annual report, a special tax notice. If your plan is a safe harbor plan, there's a notice that goes along with that. There's a fee disclosure notice that has to be sent out once a year. If your plan uses automatic enrollment, there's a separate notice for that. So what you can see here is there's a lot of notices that have to go out to your participants. Many of these notices, Nova will prepare for you, but Nova does not actually send these notices out. Nova doesn't collect any participant address information or email address or anything like that, so we don't have the information to send those out. Many record keepers offer a notice mailing service that you can use. You can also do it internally, and we're going to talk a little bit more later about a sister company of Nova called AFS that can also help with notice services, but I'll get to that closer to the end of the presentation. Okay, whoop, there it was. Okay, so got out through the moving pieces a little bit more, and now we're going into talking about distributions. So distributions have a lot of rules that are associated with them. I'm going to go through some of the higher level ones and some of the ones that you're going to encounter more frequently, but feel free to put questions into the chat box if you want to talk more about these, or if you have a specific distribution question, and Becky and I can answer it at the end. But overall, once your money gets deposited into a 401k plan, it's deposited into a trust. And the IRS has very specific rules about when that money can be removed from the plan and when it cannot. So funds generally can only be distributed from the plan if they meet one of 4 reasons. Okay, and the reasons are here listed on the slide. Termination of employment, whether that is voluntary or involuntary. If you exceed the age of 59 and a half, a hardship withdrawal, or if a participant passes away or has a total and permanent disability. Okay. Of these, the age 59 and a half distribution and the hardship distribution are optional provisions. Plans do not have to add those provisions. They are optional. But the other 2, they can be, they have to be allowed according to the IRS. Okay. So termination of employment and the retirement distribution, again, that's voluntary or involuntary. This is probably the one that you're going to deal with the most frequently. Withdrawal forms can be submitted prior to an employee's termination date, but we cannot actually take a distribution or process the distribution for the participants' funds until their termination date has passed. In addition to that, many times when an employee terminates, especially if they have ongoing deferrals, their last contribution hasn't been deposited to the plan on their termination date. And we don't want the employee to take on additional distribution fees. We don't want to do the additional hassle of filling out distribution forms more than once. So a lot of times either NOVA or the record keeper or you as the plan sponsor will hold on to the distribution forms, whether they're completed or not, until the final deposit has been made into that participant's account. So that's a couple of timing things around termination of employment distributions. There is also a special tax notice that has to be provided to participants when they terminate employment. And that notice essentially it's all form language provided by the IRS, but it essentially walks the participant through what all of the tax consequences are for each distribution option that they have, whether they take the money in cash, whether they roll it over to a IRA or to another qualified plan. What if they have a participant loan outstanding? What if they have Roth money? All of that information is put into a notice, again, where the language is mostly provided by the IRS. If you don't have a special tax notice, get with your NOVA 401k account manager, and we'll be able to provide one for you. Okay. So as I mentioned before, age 59.5 distributions are not required to be allowed by a plan, but many plans do offer those. This allows employees to make retirement plans while they're still working. The IRS says that employees cannot withdraw employee deferrals, safe harbor contributions, unless they have reached at least age 59.5. Okay, so they cannot make that age any earlier, but you could make it later if you wanted to allow these withdrawals at all. Other employer contributions, like a regular employer match or a employer profit sharing, you can set a lower age requirement on those specific contribution types if you choose, but for ease of administration, many plan sponsors just, if they allow this, they put everything at the same age, 59.5, to allow the withdrawal, okay? Right, moving on to hardships. So again, hardship distributions are not required to be allowed within the plan. Again, a lot of plans do offer them, but there are certainly several out there who do not. But what it does is it allows employees, even that are younger than age 59.5, to access their 401k account if they have an emergency, okay? The emergencies have kind of changed over time, but the ultimate thing is that the participant has to prove that they meet the emergency, and that means they have to provide an invoice or a bill or something to prove not only that they have this emergency, but it meets one of the requirements that are imposed by the IRS as to what's an acceptable use of these funds, okay? In addition, if your participant is under the age of 59.5, the hardship withdrawal is still subject to the 10% early withdrawal penalty, okay? So even though they have an emergency and they're accessing the funds under that, it does not get them out of the early withdrawal penalty that the IRS imposes for distributions taken from a qualified plan before the participant reaches age 59.5. Okay, so like I said, the reasons for hardships have changed a little bit, but this is the current list. So you can take a hardship withdrawal to purchase a principal residence. Okay, so whether that's to purchase an existing house, to buy a new one, to buy a trailer or an RV, those things are allowed, okay? You can prevent your eviction from your principal residence. So that can be an apartment, that can be your house, that can be, you know, anything that you use as your primary residence. You can use a hardship withdrawal to pay for unreimbursed medical expenses. The specific language there is unreimbursed, right? So if a part of your medical expenses are going to be paid by your insurance, you cannot take a hardship withdrawal to cover those. Post-secondary education is another reason. So you can pay for tuitions, room and board, books for a post-secondary education institution for you or for an immediate family member. Burial expenses I'm going to do next just because it's a little bit simpler. Obviously the participant isn't going to take a hardship withdrawal to pay for their own burial expenses, right? That's a little bit of an oxymoron, but you can take a hardship withdrawal to pay for the burial expenses of a family member, okay? So that is another option. And then lastly is casualty losses. So what that is pretty much if you have a loss that your insurance would cover, but either you don't have insurance or you don't have enough insurance to cover it, you could take a hardship to cover that. The casualty losses category has also been expanded to any loss that would be attributable to something that was declared a disaster by FEMA. So, for example, the winter storms in Texas and Oklahoma have been declared a disaster area, and so hardship withdrawals can be taken to pay for expenses related to that if they're going to be unreimbursed by another method. Okay. Okay, I'm going to skip over this because we are now in 2021, so the new rules as of 1/1/19 are a little bit out of date. So we're not going to spend too much time on that. Distributions based on because of death. So if you have a participant who passes away, then the account is distributable to whoever the participant has listed as the beneficiary. Many 401k plans historically have not been great about requiring participants to get beneficiary elections and having them on file somewhere, okay? I encourage you, if you take one thing away from this webinar, take this away, get beneficiary designations from your participants that are participating in your plan. Better yet, get them for everybody, okay? It is a giant pain when a participant passes away with no beneficiary on file to find who should be getting those funds, and oftentimes there's a fight about it among the people that are related to that participant. It saves everybody a ton of time, a ton of headache, a ton of heartache if you have good beneficiary elections on file. NOVA does not keep beneficiary designations. Most of the time, your record keeper does not keep beneficiary designations. So it is one of those things that you as the plan sponsor are going to want to have some kind of a process in place to handle. Okay, a type of distribution that wasn't listed on the first slide about this, but is very important nonetheless, is age 72 distributions. These are also known as required minimum distributions. So beginning with a year that an employee or a former employee turns age 72, the employee must begin taking money out of the 401k plan. This is an IRS rule in order to generate tax revenue for the government, okay? They want these participants to start taking mandatory minimum distribution amounts so that they're included in taxable income, and therefore the Uncle Sam gets a little tax revenue, okay? If you are a non-owner employee and you're still working, and when you reach the age of 72, you can delay taking these required payments until they terminate employment, okay? So a lot of times, if you have people that are in this situation, they want to keep working, that's fine, and it gives them a pass on taking these distributions until they actually fully retire. Another type of distribution is a quadro for qualified domestic relations order, okay? So this is when a participant and their ex-spouse complete their divorce, and is the only way that a participant's account balance can be assigned to another person, okay, is through a quadro. It has to be signed by the judge, and like the slide says, the rules are very complicated. NOVA does help a lot with quadro distributions. So if you get a quadro form or a participant who's asking you about it, call us, we can help you with it, okay? Okay, most plans do not require spousal consent in order to process distributions. There are some plans, especially if your plan has been around for a very long time, that still require spousal consent. But even those plans, spousal consent is not necessary if the distribution is under $5,000. So if your plan has a spousal consent requirement, it is likely that at some point in history you had a money purchase plan merge into your 401k, or if you have some kind of like a floor offset arrangement with a defined benefit plan, you could have spousal consent. But again, this is a relatively rare thing any longer. If you do have spousal consent, you want to make sure, or if you think you do, you want to make sure by checking with your account manager. Here at Nova, we can help you make that determination. Okay. So we're moving out of distributions, we're moving into loans. We got 15 minutes left in our session, so we're doing just fine. So plans don't have to offer loans to their participants, but they are very popular. Participants love being able to access their funds in their 401k plan. And plans that don't allow loans can see a reduction in participation in the plan as a result. Because participants, especially your younger ones, are sometimes hesitant or reluctant to put their money away for 40 years without being able to access it if they need it. Borrowing from the plan as a participant loan is not a taxable event, so there is no Form 1099-R. It's not included on the employee's taxable income as long as they repay the loan. There are certain formalities that are required for loans. Every plan document that includes loans at Nova has a loan policy in it that details how many loans are allowed at any one time, what the minimum loan amount is, how long you can take the loans for. So there's a lot of different rules around it, but your Nova account manager can definitely help you answer any questions about your loan program that you may have. So participants can borrow up to 50% of their vested account balance. So that is only the money that is vested in their account. They can't borrow based on unvested amounts, but they are also capped at $50,000 total. And even that number is reduced by their highest outstanding loan balance in the last 12 months. Okay. Like I mentioned, many plans have a minimum loan amount. Usually $1,000 is a popular one, just because if you start getting below that, then the amount of fees that it costs to initiate a loan end up eating a large portion of the loan proceeds for the participant. Okay. All right, this is a big one. Loans have to be at a reasonable interest rate. Okay, loans aren't designed to be a low interest rate option for participants. It's supposed to be charging an interest rate that is similar to what the participant would get if they were to get a commercial loan. Okay, so usually for Nova clients, we set up the interest rate at the prime interest rate plus 2 percentage points to get closer to a commercial rate of interest. The interest amount is paid to the participant's account, so it's not like the participant is paying a third party that interest, but it is still something that the IRS requires. Loans have to be repaid within 5 years. If you have a residential mortgage loan, you can spread it out to up to 30 years, depending on your plan provision, but there are very few residential mortgage loans that are taken out of 401k plans generally. Loans are paid through a payroll deduction. So we don't want participants mailing individual checks every week or every 2 weeks into their record keeper to pay down their loan. Most record keepers anymore will say, no, you need to send that to us through your payroll file. So if you want to add loans to your plan, you want to make sure that your payroll system is set up to handle those loan payments. When your participants terminate employment, if they have any loans outstanding, those amounts become due and payable to them within 30 days. That's the entire amount, no matter how large their outstanding loan balance is. If they do not pay that loan balance off, then that loan is treated as a taxable distribution to them, and they have to report it as income for the year. Okay. There can be initiation fees and maintenance fees for loans. Participants 9 times out of 10 will bear the costs of those. Those fees will be charged directly to the participant account. Usually, well, oftentimes, participants who are requesting loans are trying to get the money for a very specific purpose, and they generally speaking want that money as quickly as they can get it. The fastest way to do that is not use a paper form, is to submit the loan request online through the record keeper's website. They can also request to have the loan proceeds paid to them via ACH instead of a paper check that has to be put in the mail. Okay, so if they're looking for faster ways to get their money, these are the 2 recommendations for you. Okay, so that was participant loans. Now for our final section of the presentation, we're going to be talking about the annual calendar for a plan. Okay, not all of these boxes that are in here are going to apply to every plan, but these are all kind of good FYI pieces of information. I'm going to make sure to focus on the action items for the plan sponsor so that you guys can have a better idea of what you need to be worrying about. Okay. So January is a big month because that is when we are going to ask you plan sponsors to send us your year-end census information. Okay. Most of our plans have a calendar year plan year. So January, we're going to start asking you for the information from the prior year. The other thing is, January 1st is a plan entry date for just about every plan out there. So you want to make sure that you're enrolling your new participants and all that good stuff. Okay. February, if you haven't given us your data yet, we definitely want you to get it to us. We're working on annual compliance testing during this time. And then if you have an entry date that's in February, you want to make sure that you are getting your new employees enrolled. Okay. March 15th is a big date for plans that are not safe harbor, because if your plans fail any of the non-discrimination tests that Becky talked about earlier, then March 15th is the deadline to correct those failing tests, usually by distributing excess funds to the highly compensated employees. Okay, so that's the big deal in March. And while March 15th is the deadline, many record keepers need a day or two ahead of that in order to get your forms processed on time. So really, that deadline becomes closer to March 10th, in some cases March 5th. Okay, moving on to April. So the April 15th is the deadline for aged 72, those required minimum distributions, for people to get them done for their first one. Okay. April 15th is also the deadline to process and distribute any excess deferrals that were deposited to the 401k plan in the prior year. So if you had someone who went over that $19,500 limit and they are not catch-up eligible in 2020, they have until next week to get those excess amounts paid out, or additional tax consequences and excise taxes apply. Okay. In May is when we really want our large filer participant plans, so our plans with more than 100 participants, to start working on their plan audit for the year. Okay, that's going to be part of their Form 5500 process. So that'll be a big one. Nova can help a lot with your audit, so when you get your questions from your auditor, please loop in your Nova account manager and we can help you out with a lot of that. Okay, June 5500 and the audit work continues is pretty much the big one. And that's June is a relatively dead month other than that work. Okay, July is the unextended deadline for the Form 5500. Okay, so all that audit work you've been doing for the last 2 months, all the work that Nova's been doing to prepare your Form 5500, July 31st is the due date to get that form filed with the Department of Labor. Okay. You can extend the Form 5500 filing deadline. Nova makes it our job to help you not need to extend it, but if you do, we can. It's just that July 31st is our big deadline for that. Okay. In August, Nova begins to offer mid-year testing. So if you're not a safe harbor plan and you want to try and avoid ADP ACP refunds for the year, we can do a year-to-date census for you and look at that and use that to project out if we think that your plan is going to pass that compliance testing or if it's going to fail and require refunds again. So it's a good planning opportunity if you are a non-safe harbor plan. In September, Nova will begin what we call our cash out project. Okay, so participants who have terminated employment and have a vested account balance of under $5,000 can have their money forced out of the plan to an IRA that is set up on their behalf. If you want more information about that, do contact your Nova account manager. We're running short on time, so I'm not going to get too far into that. Okay, October is the extended Form 5500 due date, October 15th, right in the middle of the month. Okay, so that is, if you have to extend, that is the absolute drop dead date to get that form filed. Okay, Also in October and November is when we start our annual process of this age 72 required minimum distributions. So that's also a fun time. November is better known for the month where most of your notices have to be delivered. So safe harbor notice, default investment notice, auto enrollment notice, to name a few, need to all be distributed to your participants in the month of November. Okay. And then in December is the deadline to correct any compliance testing failures that you have. It's also when you want to make sure your summary annual report needs to be distributed to your participants. And, you know, it's also the holidays, right, where we don't want to be worrying about our plan too much. All right, so I mentioned AFS earlier. This is our sister company, and they offer a notice mailing service. So if you heard me talking about the notices and you got weak in the knees or you got felt a little faint, contact Jacob H at afs316.com, and they can talk to you about what notice services they offer, how they can help take that burden off of you, and give you one less thing to worry about as you're dealing with your plan. You know, some plan sponsors have a system and it worked great and it's beautiful and that's fine. Other plan sponsors are like, oh man, that is just one lift too much. And so this type of service is a real godsend for them. Okay, we do have more webinars coming up this year. So if you liked what Becky and I had to say today, we encourage you to check out our future webinars. I can't promise that everyone's going to be as engaging as I am, and certainly not as engaging as Becky is, but we do a pretty good job. We have a little bit of fun with them, so we encourage you to check us out. And I think for the CPA folks, for Texas CPA credit, remember that you're going to get an evaluation survey. You do have to fill that out in order to get your certificate of your CPA credit. And with that, I'm going to turn it back over for questions.
Thanks, Jason. We did receive a handful of questions, so I'll go ahead and ask you the first one. So the first one was asked around slide 46. The question is, what if funds are distributed before an annual match contribution? What should happen to that match money?
Excellent question. And I'm excited that all of the questions appear to have been on my part of the slide, so that's good. So yes, this often happens. You have a participant that terminates employment during the year. They take the distribution of their account, and then at the end of the year, NOVA calculates their match. The match gets deposited, and all of a sudden you have a balance again for this participant. Generally speaking, a participant's distribution forms, like the signature on them, is good for anywhere between 30 to 90 days, depending on the record keeper. So if it's a short enough time window, we might be able to process that second distribution without the participant having to fill out additional forms. If it is longer than that though, then the participant will need to be contacted, be told about their new balance, and then have to fill out additional distribution forms.
Thanks, Jason. This next question didn't provide a slide number, but the question is, if an employer fails to notify an employee when qualified for enrollment, what % would be used for missed deferrals?
Wow, all right. Someone's been reading some manuals. I like it. So yeah, so there are sometimes occasions where a participant becomes eligible for the plan and the plan sponsor is unable or misses or just doesn't tell them about it, right? So sometimes the participant will have a number in mind of what they would choose to defer, right? And then you can make a contribution. The IRS specifies how to correct these, and it's called a missed deferral opportunity. And what it is you take 50% of the amount that the participant wanted to contribute but didn't get a chance to, and then you deposit that to the plan on their behalf, not out of their paycheck. The employer makes a contribution for that. And then that participant is also entitled to the full amount of any match they would have received if they would have deferred that amount. Now, if you have a situation where a participant doesn't have an amount to provide to you, or it was after the plan year is over or something like that, then the amount that is deposited to the participant's account is 50% of the average of the rest of the plan. Okay, so if the rest of the company is deferring 5% as a group, then you would that participant will be considered of electing 5%, which means that the plan sponsor puts in a contribution of 2.5% of that participant's pay as a contribution to the plan. Again, plus any match contributions that that person would have missed based on that 5% deferral rate. So if you have a specific situation, definitely contact your NOVA account manager. We can help you with those calculations and make sure that everything gets cleaned up and deposited correctly.
Perfect. And then our last two questions are both related to loans, slide 58. The first one is, if a terminating employee can't repay the balance of the loan and it becomes taxable, is that on the entire loan or just the balance?
Yeah, so that is just on the remaining unpaid balance is what becomes taxable to the participant. They won't get taxed again on the amount that they've already paid.
Okay, and the last question, so the interest on a loan is paid back to the participant?
Yes, yes. So the participant is taking money out of their own account, and so the IRS has required that they're repaying the interest back into their account. They don't want the participant to miss out on potential growth of their retirement assets just because they choose to take a loan. So what they say is you have to charge an interest rate, but that entire amount of interest gets paid back to the participant's account.
Thanks, Jason. So that's all the questions we received. Do you or Becky have any closing comments?
No, I appreciate you all hanging with us. An hour and a half is a big commitment, and I hope it was useful for you.
All right, and thank you again, everyone, for joining us today for an introduction to 401k plans. Please note there will be a survey that will pop up right after the webinar ends for you to complete if you are needing Texas CPA credit, so be on the lookout for that. The certificates will be sent out in 1 week, and a recording of this webinar will be made available on our NOVA YouTube channel by the end of next week, along with a link to download the slides. If you have any questions, please reach out to your account manager and they will be happy to assist you. And for any other questions, please email us at webinars@nova401k.com. Everyone have a terrific Thursday.